Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks track Wall Street's rebound with dip buyers stepping in after a rout in tech shares. Treasuries under pressure amid signs of U.S. economic resilience. Uncertainty reigns as the U.S. Supreme Court questions President Trump's use of broad powers to impose tariffs. We'll get insights from AmCham Shanghai at the China International Import Expo. Also ahead, we look at how wealth managers are navigating the current market environment, speaking exclusively to BNP Paribas and EQT Asia. Plus, dueling debuts. Chinese robotaxi rivals Pony.ai and WeRide fall in Hong Kong as they battle for investor support for their public offerings. Our top story today, Asian stocks getting a reprieve from yesterday's bruising sell-off. Dip buyers are piling in after concerns over stretched valuations triggered a brief pullback in AI-related names. For more on the market action, let's bring in Bloomberg MLive strategist Mark Cranfield. Well, that sell-off didn't last long. Just buy the dip.
Yeah. I mean, it helps that you get comments overnight from Jensen Huang from NVIDIA saying that he thinks that China could lead the race in AI, partly because of the power consumption issue. Now, those kind of things, if it's good for China, it's good for the rest of Asia as well. So it helps to keep the whole AI theme going. And the countries that have been leading it, obviously, have been Korea, Taiwan, Japan to some extent. And so those markets are pretty buoyant again today. And they don't have some of the issues in terms of the earnings. There's been a mixed set of earnings coming out from the US. That's why you can see Nasdaq's down a little bit today. But most of these big names are still coming. We won't have Tencent, Alibaba and JD.com for a while yet. They're coming up next week and the weeks after. So people have still got a bit of time before that. And they're, in relative terms, they're still not pricing the same kind of multiples as you see in the United States. So that gives Asian investors, who've probably been waiting for some time, a little bit of dip to come in. And if you look at, for example, the Korean futures market, very high volumes this week. At one stage yesterday, the Kospi was down 6% intraday. And all you saw was people supporting the futures market. So open interest actually rose, which is a sign that people really were buying that dip in Korea.
You talk about how the markets in Asia are driven by China, but the markets here have been driven by the U.S. You know, the capex that we've been seeing, that's driving that sentiment. If China benefits, then the U.S. could pull everybody down.
It is. I mean, ultimately, the biggest risk to global markets is that you get a very serious setback in the United States. Nobody is going to be able to escape that, that's for sure. But if you look at the performance in the past few months, you can see that money has gradually been shifting from the US, especially to Asia, to some extent to Europe as well. Overall, those markets are outperforming in relative terms compared to the United States. It's also helping the fact that for a while the US dollar was a bit softer. It's rebounded slightly recently, but in general, the dollar's still down since Donald Trump was inaugurated. And that certainly helped. The fact that US yields have been coming down as well has helped Asian people to keep rates soft as well. The backdrop is all very supportive. And when we started the year, we come off of a 2024 when the US outperformed so much, people were thinking, well, this just can't continue at that pace. And it hasn't. This year, it's all been about catch up in the rest of the world.
And the feel good is also coming in the IPO market. If you take a look at, what's happening in Hong Kong, oh my goodness, the number of IPOs that are happening there, that's boosting sentiment in a huge way.
It is, but it's becoming a double-edged sword now. We've reached a point now where it's also becoming a headwind. If you look at last few weeks, the big tech companies in Hong Kong, measured by the Hang Seng Tech Index, are underperforming Kospi and Japan because the pipeline is more than 300 IPOs in the pipeline. That's more than the last 3 years put together for Hong Kong. There have been some very good ones, but like today, we see two are struggling today. They're coming out on the same day. So appetite is beginning to wane, and fund managers have to keep money back. If there's a lot of IPOs coming, they will have to set aside some money for those new issues, which means it can't go back into the existing market. So from here, it's going to probably be difficult for Hong Kong to outperform if they think that all those IPOs, and some of them they will try to jam them in before the end of the year. So that big pipeline becomes a headwind for Hong Kong.
Mark, thank you so much for that. Bloomberg M Live strategist Mark Cranfield there. Let's get more on the impact that these new listings may have on the broader markets. Joining us exclusively, Arnaud Tellier, CEO of BNP Paribas Wealth Management. Arnaud, when you take a look at what's happening in Hong Kong, those IPO after IPO after IPO, I mean, it must be creating a lot of new millionaires, a lot of wealth. How is that impacting what you're doing in Hong Kong?
Yes, hi, good morning. It's been indeed an amazing year for the wealth management industry and for also our clients in Greater China and particularly in Hong Kong. We can say Hong Kong has regained its footing, is back with indeed all of these IPOs. And you know, I'm not too concerned about the timing. I'm not too concerned about any potential correction because what's important is that we have all of this wealth creation coming from China, coming from Greater China. It's not just China, but Taiwan as well plays a very important role. And it has made investors and wealthy individuals and clients a lot more confident into investing into this market. Also, I agree with what was said earlier. Valuations in this part of the world are probably a bit better than what we can see in the US, and that makes us a lot more constructive into this market.
You talk about how wealth is being created at scale. Give us a sense of how quickly wealth is being created. Is the wealth management business at an inflection point, you think?
It is indeed in terms of wealth creation, but you know, this industry has been navigating the cycles of the last 5 years pretty well. If we speak about BNP Paribas, we've been growing our top line more than 10% over the last 5 years. But indeed, there's clearly, since last year, there's an inflection in terms of wealth creation and AUM growth. There's lots of wealth creation in Greater China. I mentioned Hong Kong, mainland China, and Taiwan. Let's not forget about Taiwan, which is doing amazing, not only in the microchip industry or AI-related business, but there is this network, this web of entrepreneurs in Taiwan that are still creating a lot of wealth. And Hong Kong, Singapore as well, but Hong Kong is playing its role as a gateway to all this wealth for being invested. And indeed, we saw an inflection point in 2024, but which is gaining momentum in 2025, where we see, of course, a lot more confident into investment flows into Greater China, Hong Kong, China, and this wealth creation is, of course, being channeled through the wealth management industry into global investments. We also see what's interesting. Sorry.
Arnaud, what kind of AUM growth are you anticipating, and is that sustainable in the next 2 to 3 years?
Yeah, so AUM growth is both a function of wealth creation, but also market performance. So this year has been quite amazing. We assess that the wealth creation being channeled offshore was about 10%. If you combine it with a market performance of 5 to 8%, that's quite significant. As far as we are concerned, it's been an amazing year for us. We saw our growth of our assets by more than 20%, also growth of our top line by more than 20%, and we are still pretty positive on the medium to long term in China and in Greater China. We see growth of addressable wealth growing from 7 to 10%. According to the regions, if we look at Hong Kong, China will probably be around 7 to 8%. Taiwan probably double digit. Southeast Asia a bit less, but you know, we're talking about Hong Kong becoming the largest wealth center in the world, and Singapore catching up fast. So this is a clearly very exciting moment for this region, and we see this trend continuing. So we are pretty positive about the outcome of this industry. And as I said, we're really talking, and that's what we are targeting as well, something like a double-digit growth in terms of assets under management.
Arnaud, my colleagues at Bloomberg Intelligence say that mainland Chinese could account for about 30% of new clients in the next 3 to 5 years, new rich clients in the next 3 to 5 years, from 26% currently. Do you agree? Could the number go higher?
Absolutely. By the way, China has been our highest growth market this year. We've been fortunate to invest into new talents last year, which has helped us as well. It's a reason why we have also reorganized our setup to make sure that we have, we're dealing with offshore assets only. So it's, of course, cross-border assets, but with the flow of IPOs, that's how this wealth is being created and being channeled to offshore hubs like Hong Kong and Singapore. And what we've seen is that our bankers covering China have been the most successful ones. What's interesting as well is that we see a lot more diversity into the type of entrepreneurs we see. We're talking about tech, but it's not only tech. We have a lot of innovation in many different sectors. And of course, China is such a big pool of wealth, such a huge country. We can see a lot of differences in terms of business needs, in terms of expectations. You don't cover in the same way a sophisticated family office in Shanghai as you would do as an emerging entrepreneur in Sichuan, and that's why we need to have the teams that are really focused, sophisticated, knowledgeable. If you don't know China, there's no way you are going to be able to cover efficiently and bring value to this market. That's what we have done by building those new teams out of Hong Kong, but also Singapore.
Arnaud, I'm just wondering how the wealthy Chinese are wanting to invest in this current environment. We know that a lot of the mainland Chinese are underinvested overseas. Is that changing?
This is changing, and it's a very interesting phenomenon. When I was traveling to China 5 years ago, my clients, the wealthy people, the wealthy clients were saying, okay, what I want from you is financing, and I will be able to invest in businesses in China. And they learned their lessons, I think, sometimes the hard way, unfortunately. So now there's a need and a demand for diversification, professional asset allocation, but also new opportunities. For us, being a European bank, that's also a great opportunity because, of course, Chinese know their markets very well. They're also pretty knowledgeable about the US market, but they are today fairly invested into US market, which is probably richly valued. And we have a lot of questions about Europe. We have a lot of questions about opportunities in Europe, and I think we are very well placed to offer those opportunities. It's still, let's be honest, it's still a small part of their portfolios, but that's where the opportunities is to make it a more important part of their asset allocations. And I believe we are one of the best places to offer and advise and recommend on these opportunities.
Arnaud, on the show, we've been talking about the trend of de-dollarization, how people are pulling back from U.S. assets. Are you seeing that when it comes to Chinese money, Chinese wealth, on the back of U.S.-China tensions? Are they pulling back from the U.S.?
Well, the dollar has weakened, as we know. So, of course, if you are not dollar-based, you are doing better by investing into other currencies. Do we see a major de-dollarization? Maybe not, but it's a trend that is starting, and and we are convinced that it's going to intensify. A lot of interest in euro. Euro is a lot stronger than it was at the beginning of the year. So, of course, for a dollar-based investor, having your portfolio into European assets, you're doing a lot better than having your portfolio in dollars. So, yes, we see that trend starting and continuing. But, these things can move in cycles. So right now we probably have a bit of move away from not only dollar but dollar-based assets.
Right.
But as you know, cycles can change, and we may see that reversing into the future.
Arnaud, thank you so much for your time today. Arnaud Tellier, BNP Paribas Wealth Management, APAC. Now, still ahead on Insight, we head to the China International Import Expo in Shanghai to assess the outlook for the trade truce with the U.S. AmCham Shanghai President Eric Cheung will be joining us next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. The U.S. Supreme Court has cast fresh uncertainty over President Trump's sweeping tariffs, suggesting the president may have overstepped his authority. In a nearly 3-hour hearing, the court hinted it was ready to put significant limits on Trump's landmark economic policy. Bloomberg Intelligence believes there is now a 60% chance that reciprocal and fentanyl tariffs will be deemed unlawful. Bloomberg Economics, for its part, says a sweeping ruling against Trump could reduce the average effective U.S. tariff rate from 14.5% to 6.5% and require billions of dollars of refunds. Let's cross to the China International Import Expo in Shanghai, where our China North Asia correspondent Stephen Angle is with our next guest. Steve.
That's right. So that's an interesting comments coming from the Supreme Court, obviously, because the tariff regime over the last, 9-10 months, obviously has an impact on the American businesses that are doing business here in China. Let's bring in our guest. He is Eric Cheung. He is the president of AmCham Shanghai. Thanks so much. It's a bit noisy here because there's a signing ceremony going on in the booth over there, which is good news when you're getting a cross-border deal being signed. But we were just talking about the tariff regime. Obviously, it was a year ago when we were last here in this exact spot at the AmCham booth talking to people as Donald Trump was being elected and giving his victory speech. It's been a tumultuous year on the trade front. Give me an assessment based on what you saw in your September business confidence survey of American members and the impact that it's had, the tariffs, on confidence.
Well, certainly for our members, we've gone through a lot. And the U.S.-China bilateral relationship is definitely the number one concern. We're looking for some stability, some predictability. High tariffs are hurting everybody, hurting both sides. We're standing in front of some California wines. Currently, they're subject to over 100% tariffs still. But I think after the Busan meeting, we are seeing some progress, right? The U.S. side has decided to lower its fentanyl tariff by 10 percentage points, and China has stepped back also. So I think we're looking for some more stability in the next 12 months at least.
What has it done to the U.S.-China relationship commercially? Geopolitically, we know it's very tenuous right now. How badly has it damaged the commercial relationship?
Well, we have kind of 3 challenges, frankly. The number one is geopolitical uncertainty. Number 2 is really fierce domestic competition here too. And these Chinese companies are becoming very, very competitive. And number 3 is really the slowdown of the economy. So those are the 3 challenges that our companies are faced with here in China. But our companies still see this market as very significant for them and look at CIE, and we have many U.S. companies participating in this one, and they see the market as significant enough, so they try to showcase their products here. Now, our pavilion, American Pavilion here, focuses more on agricultural products. So we had very good news from Busan that the Chinese side is willing to purchase more soybeans from the U.S. side. By the end of this year, China is committed to buy 12 million metric tons of soybeans from the U.S.
But they didn't buy from the beginning of the harvest, so this was a political bargaining chip that the Chinese employed. There's no guarantee that the soybeans obviously is going to offset the overall trade imbalance coming into China of U.S. goods. Where do you need to see better improvement in what other sectors?
So I think we definitely need more soybeans, so that farmers and ranchers can sell more to this market. But in addition, I think our companies have to sell more in other industries, not only manufacturing, but services. So I think we are faced with still some challenges, structural challenges ahead of us. But at least at this point, we have a temporary truce, and the two leaders are planning to visit each other next year. So that will give us some temporary stability, and China will host APEC next year, and the US will host G20 next year in Miami. So I think at least in the next 12 months, we'll have a little bit more stability. That's always good for us, our companies operating in China.
So in September, you had the most recent China business confidence survey of your members in your chamber. It was not very good. Obviously, we had about 6-7 months into the tariff regime. We're just looking about diversifying supply chains, those that were going to be moving their or diversifying their operations or supply chains out of China at 47% is quite high. And their 5-year outlook for a 4th consecutive year was at a record low. Does this rapprochement at all, this de-escalation with the leaders meeting, does it move the needle at all, or is the de-risking and the diversifying going ahead on both countries' side?
Keep in mind that we did our survey after April the 2nd when the trade war started, and the companies were very concerned about the future, obviously from a trade relationship standpoint. And certainly diversification, strengthening of supply chains, that's been going on for quite a while, and after COVID. And you mentioned that 47% number, meaning 47% of our companies who were originally planning to put more capital into China, they move it to somewhere else. So the companies are still here, but they diverted some of the capital to other locations.
I think you're calling it shock-proofing those supply chains, but that's a long-term trend, isn't it?
Yeah, it is happening. Certainly, friendshoring is happening in a significant way. Half of our companies among those 45%, over 51% move their supply chains to Southeast Asia. So that's friendshoring. Some to India, a little bit to Mexico, but reshoring is not happening in a big way, only 18%.
Okay.
So because I think the U.S. has to do a lot more in terms of rebuilding its infrastructure, its ecosystem for manufacturing, even skilled labor in order to attract more investors coming to the U.S.
It's still early days. It's just a week since those two leaders met. Are you seeing any tangible evidence that the countermeasures that China put in place to counter Trump's tariffs, they've relaxed some of them? Are you starting to see those countermeasures coming back off?
Well, I think the Chinese side is committed to this suspension, right, of certain countermeasures, including rare earth exports and so forth, and that's just for 12 months. So it's certainly the two sides have continued to talk to each other, and I think our hope is that we can go beyond that. Right now, my understanding is that companies continue to apply for licenses for rare earth exports, and they're getting some of those.
Eric Jung, thanks so much for your time here in a very noisy CIIE. Haslinda, back to you from Shanghai.
When it comes to the rate environment, there's also another thing to keep in mind. Lower cost of debt is certainly good for investments, but also commercial real estate investors like to look at the risk-free rate, which is the 10-year bond yield.
That increased 10-year has really reduced supply significantly. When housing falls at that level, you start to see demand, which is going to increase, as we spoke about, in terms of the demographic trends. And so as a result, you're really going to see pressure on rental rates and housing costs because of the fact that there's no supply.
Some of our guests this week sharing their insights on how interest rates are impacting property markets. Let's dig further into this topic with William Beardmore-Gray, Senior Partner and Group Chair at real estate consultancy Knight Frank. William, good to have you with us. We've been talking about, the outlook for interest rates. It's no longer clear what the Fed might do in December. What assumptions are you making, and how might that impact sentiment in the property space?
Thank you very much for having me on. I've learned for quite a long time now not to make assumptions about interest rates, but I think our feeling is that should the Fed reduce rates, which is definitely a discussion point at the moment, that should only increase the amount of outbound investment we've been seeing from the US over the last 6 months. 23 billion in quarter three came out of the US, 12 of which landed in the Asia markets. So that attraction to the sort of hot stocks at the moment, whether that be living sectors, logistics, or data centers, we see only increasing.
It's not just the Fed uncertainty, it's also tariff uncertainty. In terms of reallocation of funds, fund flows, you talk about how a lot of them are actually headed to Asia. How about markets like, UK, Germany, France? How attractive are they right now?
Well, the UK is still, and particularly London, probably the greatest receiver of cross-border capital. Europe has been very attractive over the last 6-9 months, probably ahead of, that's mainland Europe, ahead of some other markets because of the steady reduction in rates that we've seen there. But across the board, quarter three saw a 32% rise in cross-border capital, and one of the most significant receivers of that was Asia. 64 billion in Q3, a 57% uptick year on year. But one of the really interesting pieces of that spend was that a real significant amount of that was actually Asian capital remaining in Asia. So we've seen that tariff uncertainty, but it's very clear to me that we're starting to see a recovery from the buffeting that we took back following Liberation Day, and the corporate real estate sentiment is better now than it's been since quarter three 2022.
Which markets in Asia in particular are attracting global capital? Some point to Japan, where it's stable, it's transparent, it's liquid. How are you assessing that market?
Stable, transparent, liquid. Those are three words I would definitely use. I mean, Japan is a safe haven market. Really attractive. We've seen Bloomberg's recent transaction at Tokyo Garden, 2.6 billion, the largest investment by a foreign buyer. But across, Asia, I would like to say is a real all-rounder. It's manufacturing base, it's significant adoption of technology, and the significant rise in its consumer base, particularly between now and 2030, makes it a hugely attractive market. And those locations that people are focused on, particularly for commercial property, are Tokyo, Seoul. Australia is attracting a lot of interest. Singapore obviously will continue to do so. And the market which I believe is very interesting and is mentioned consistently with investors that we're speaking to at the moment is India.
What about India?
Well, India's probably been the biggest winner in the sort of China plus many locations, some of the diversification away from that market. And India has developed itself not just into probably one of the largest office markets in the world for quality space, but it's become a real manufacturing base as well. The abundance of talent, we all know the story, and the size of that market is making it a market that people want to look at very closely. But it's a complicated market, we're advising many investors who are looking at that market now, particularly there's great opportunity to partner with local investment and local developers.
William, our previous guest talked about reshoring. It does seem like India is benefiting from reshoring, manufacturing, gravitating away from China, perhaps more to the country. Is that what you're seeing as well? In terms of capital flow, are you seeing capital flowing away from China into India, perhaps?
Well, you're seeing capital flow into India. You're seeing it flow into Japan and into other areas. The extraordinary sort of expansion of global capability centres across Mumbai, Bangalore, Delhi, Hyderabad, has seen a take-up in offices last year of approximately 70 million square feet. We expect that to be, nearer to or exceed 80 million square foot this year. So that type of activity by really high-quality global occupier base is going to drive development, not just in Grade A offices, which clearly is a significant focus, but now the increased activity in industrial and logistics and data centres in India is significant. And that's going to drive and pull investment into the region.
Right. So I'm just wondering, when you talk about, the appetite for office and logistics space in India, that shows perhaps the long-term confidence in the country. After all, at 7.8% currently and expected to grow even more in terms of GDP, that certainly is an attractive pool for in the Indian market.
Yeah, and the confidence in the Indian market from investors is based on, probably one of the largest and best educated, talent pool in the world. And so, occupiers, large corporates know that, they can, long gone are the days of, the BPOs who moved out of India. Now it's about innovation and real front office work.
William, we've also been talking about wealth creation in the region. We're seeing, massive IPOs in Hong Kong, for instance. We're seeing massive wealth growth in markets like China. Talk to us about the luxury residential market. How is that looking right now?
Well, residential markets around the world are patchy. We only saw 3.6% across Asia last year, but particular highlights were Seoul, Tokyo, and Dubai over the last 5 years. I think those prices raised 25%, 16%, and 15% respectively. Tokyo actually over a 5-year period is probably the greatest winner in that game. But why are people investing in residential in the way that they are? Well, look, it's diversification. We've seen significant wealth growth, as you say, and the first target of ultra high net worth individuals tends to be to residential, and we've seen a lot of that sort of lifestyle investment over the past 12 months. And we think that will continue. It's a market, though, in some areas of the world it's been challenged. We know that, for example, in London, the prime and super prime markets are under pressure, but that is about policy. We've seen in Seoul itself, we've seen some cooling measures take off. But some really interesting secondary markets have emerged. Manila, for example, Christchurch is attracting a lot of interest. New Zealand, again, because of policy change and the change in the ability of foreigners to buy in that country will, without doubt, create interest. And we're a big believer in the Asian residential market. 12 months ago, we bought a business called McGrath in Australia, partnered with Bailey's out of New Zealand. So we believe that it's got real opportunity over the next 18 months.
So are you looking for more purchases in the next 12, 24 months? What's looking attractive? Where are you in talks with?
Well, at the moment, I think we're going to settle down the business that we've got in terms of Australia. Australia, we think, is a really interesting market. We're looking very closely at some fantastic opportunities here in Tokyo. We've got a great business in Hong Kong. We're looking across the region, particularly the growth of private capital. The sophistication of private capital is probably the biggest story of the last 10 years in real estate. And that's something, because of our high-end luxury residential business, we're very tapped into. So, looking at where capital flows are, where private wealth is concentrating is always high on our list.
If you take a look at the market right now, William, everything is priced for perfection. Expectations are that the Fed will continue to cut. I'm just wondering how you're assessing the risk from those expectations. Might that derail some of the assumptions that you're making right now?
Look, I mean, I said at the beginning, we're in a dangerous world for assumptions. When I was here this time last year, and we were beginning to see the early signs of green shoots in markets across the world, as we are now. And then we had the effects of the tariffs hit our global markets and create significant uncertainty. And we seem to be in a world where these types of events are hitting us more often. But there are some parts of our markets which I believe will. The markets are solid at the moment. People are set. The confidence in investors, people are seeing uncertainty as an opportunity rather than a reason not to invest. We've seen a change in the way, there was a concern basically over the last 3 to 5 years about that weight of debt in the market. We're seeing banks take a different attitude now than they perhaps did 12 months ago. We're seeing far more incentivized sellers in the market. And so the capital that's been out there for some time now is beginning to see more opportunity. And that volatility will create more opportunity.
But what's the biggest risk out there then? I mean, if you speak to the IMF, it would tell you about the surging debt level.
Yeah, well, look, I think that's something we've got to keep a close eye on. Without a doubt, it's quite a high. It's a topic which is getting a lot of airtime, particularly in the US. So that's something that we will be watching.
William, thank you so much for your time today. William Beardmore-Gray of Knight Frank, still to come on the show. Japan's top currency official says the yen's recent weakness has strayed from fundamentals. Our conversation with Atsushi Mimura is next. Keep it here with us. This is Bloomberg. Welcome back to Insight. The Japanese government's top currency official says recent yen moves are deviating from what might be expected given the difference between interest rates in Japan and the US. Atsushi Mimura told us there's been a steady decline in long yen positions owing to factors including speculation about Japan's fiscal spending plans.
if you look at the recent movements of the Japanese yen, US dollar, basically we always tell that you should always look at the interest rate differentials between the US dollars or US Treasury bond and the JGBs. But if you look at the actual movement of foreign exchange and also the movement or differentials between the US and Japan interest rates on public bonds, you do see some sort of deviation in recent weeks or even in recent months, I would say. Two aspects. The first thing is that we are always looking at some sort of speculative movements in the market, and of course, because of the government shutdown in the U.S., we don't know the figure after end of September. But if you look at the trend until mid-September, since the beginning of this year, the accumulation of yen long, dollar short position has been quite accumulated until sometime this year, around by the time of the summer. But since then, this position is gradually or even rapidly shrinking. And I assume in the recent weeks, probably it has further shrinked because of the different sort of events happening not only in Japan but also around the world.
Which means we could see more pressure.
So, of course, as the yen long dollar short position is shrinking, definitely it goes on the direction of the further depreciation of yen, of course. So this movement is one thing. And another thing is that, yes, we, as the responsible public officer, I should refrain from making any sort of too much detail or too much assessment, but we do recognize that many people say in the market that there is also some speculation or prospects about Japan's macroeconomic policies, especially fiscal policy. And so probably in the recent weeks, probably there is some prospect or speculation in the market about the forthcoming fiscal policy in this country. But of course, this is only part of the whole story because anyway, we have many other elements, including the geopolitical things and trade policies, etc. So, for example, in September, fortunately, we came to an agreement with the U.S. with regard to Japan-U.S. tariff negotiations. So this is already one big deal that also affects the market.
And that was Japanese Vice Finance Minister for International Affairs Atsushi Mimura speaking to our very own Sherry Ann. Well, for more on the outlook for the yen, let's bring in Bloomberg's chief correspondent for Asia FX and Rates, Ruth Carson. Ruth, I mean, Mimura-san talked about yen deviation. Does the market agree? How are traders responding to what he had to say?
The yen is one of the most fascinating currencies right now in markets. And I say that also because we have seen risk-off episodes and the yen's just not really behaving the way it should. So deviation, absolutely, from a traditional sense of looking at how currency pairs operate. Now, why is this happening? I think it's because investors in general, whether you are a long-only fund or even speculative hedge funds, the idea of the yen as a safe haven no longer fully applies. Rate differentials matter, but is the Bank of Japan raising interest rates as quickly as the market wants? Clearly not. Otherwise, the yen wouldn't be where it is right now. So that's what I think the debate is and what traders are grappling with right now.
The JGB market is showing some signs of unease, right? If you take a look at the 10-year JGB auction, it was pretty lukewarm. How do we read that?
Yeah, so this is the other side of the equation. JGBs, yen, they go hand-in-hand, bonds and FX and rates. Now, the 10-year auction yesterday did see a bit of pressure. The bid cover ratio has actually fallen. And in a way, it's again indicating investors' queries, probing into just how healthy Japan is as a market to own, particularly on the bond side. Now, what is even more interesting is yesterday the auction came at a time when bonds were actually bid. Treasuries, ACGBs, and you've got a lot of the bond markets here all showing strength because we saw a massive risk off with the sell-off in stocks. So the fact that the 10-year auction came in the way it did sort of raises question marks, definitely, about interest in JGBs.
So if you take a look at Japanese assets right now, the JGBs, the yen, I mean, what does it tell you about how attractive Japanese assets are, or not, for that matter?
I think that's the $1 trillion question, Has. And investors are grappling with it. Now, And from an overarching view, the yen is cheap. The yen is cheap to own, right, against a lot of currency pairs. But are you brave enough to actually dip in is the key question. And so I think you're going to find a lot of in and out trading for both JGBs and yen. And it's basically an indication that, you know what, Japan markets, especially on the macro side, are alive and well again, in the sense that there's a lot of trading either way on it compared with, even 5 years before when it was a lot more tepid.
Well, when it comes to a cheap yen, we don't really mind because we do love our trips to Japan.
We do.
It's not just about a cheap yen, it's also the cheap Indian rupee. What is the story there?
Yes, this is another fascinating story in Asia. Now, we know that the INR is one of those high-yield darlings in this part of the world. And yes, it has, if you look at where things are, come under attack, speculative attack. And it's to do perhaps with the fact that hedge funds, CTA, speculative investors going, well, is the INR a weak spot here? We still have trade tensions going on between India and the US. But you know what? The RBI certainly is defending the currency, selling dollars, both onshore, offshore. So again, a fascinating space for investors to play in and, take speculative positions on clearly as well.
Well, the thing is, there is limitation to what the RBI can do if it's a function as well of the dollar.
A great observation. And we have seen, the first couple of months, in fact, the first half of this year where the dollar bearish trade was dominating, right? Everyone couldn't wait to sell the dollar. Now things are not exactly that way. We're seeing a turn in markets, a turn in sentiment. And yes, absolutely, that would put pressure on all other currencies around the world, including the rupee. So just how long the RBI will or can defend it, sure, they have, ammunition to do so. But how long is a piece of string, isn't it, when it comes to the dollar strength?
Right. How deep is the pocket for the RBI? Ruth, always a pleasure to have you with us. Bloomberg Chief Correspondent for Asia FX and rate reporter Ruth Carson. Now let's take a look at how Asian benchmarks are doing. They're back in the money. Talk about, a very quick sell-off. The MSCI Asia Pac Index currently up by 1.3%. The Hang Seng and Nikkei also in positive territory. It is about dip buying. It is about people, of course, finding every reason to send the markets higher. Now, still to come on Insight, we're headed back to the PWMA Wealth Management Summit in Hong Kong. EQT Asia Chairman Jean-Eric Salata will be joining us exclusively in just a few minutes. And later, UBP Managing Director Anitza will be sharing her market outlook as global bond sales soar to a record this year. More to come in the next hour of Insight. Keep it here with us. This is Bloomberg.
I think WeRide has done a fantastic job in preparing all the documents and talking to the investors. So within 1 year, think about it. We were listed in Nasdaq October 24th last year. Within 1 year, achieve this kind of dual primary listing. I think it's a fantastic transcript, a fantastic score.
WeRide CEO Tony Han speaking to Bloomberg at the Hong Kong Stock Exchange as the firm makes its trading debut alongside Chinese robotaxi rival Pony.ai. And you can see shares of both stocks struggling in that debut. For more, let's bring in our China correspondent Min Lo. Min, not a great debut for either of these two companies. Why is that?
Well, it's always not a great time to list together with your competitor, right, on the same day. It's not too clear how did this happening. Was there a rush to try to list ahead of their rival and ended up just doing it on the same day? But there has been intense competition leading up to this point, because just ahead of this, WeRide had accused Pony.ai of misrepresenting its company in their investor roadshow, claiming that WeRide had made zero rights so far. And I asked James Peng, Peng, the CEO of Pony.ai, about this, and he chalked it up to a misunderstanding and saying that WeRide is a well-respected company and there's a lot of room in the global markets for both companies to prosper. So it's quite an interesting situation here. But have a listen to what Pony.ai CEO had to say about their company's international expansion plans.
We actually have relatively big footprint in our global markets. I think we're now in 7 markets: South Korea, Singapore, Luxembourg in Europe, 3 countries in the Middle East. Regulation is a key part of our business, and we want to be a strong supporter and a strong negotiator for government actually to pass the regulations. So certainly we're not in a waiting mode for the regulation. That's one point I want to make. But among all the markets at this point, seems to be the Middle East, especially UAE, seems to be probably in terms of regulation to be the fastest to approve fully driverless commercial licenses. But I think other countries definitely will follow suit. And we already have a footprint in those markets. We have good partners in those markets. And once the regulation is ready, we'll double down and push our more fleets into those markets.
You've actually been operating in the US much longer than in the UAE. What are some of the biggest roadblocks you are facing in terms of commercialization in the US?
I think that it's some geopolitical concerns. Also, there's data transfer, data storage, and some other concerns. So we deprioritized our commercialization in the US. But rather focusing on other markets.
So are you giving up plans to commercialize there now?
At least for now. Or we should say, at least we paused.
So they're pausing this push to commercialization in the US. And actually a part of the reason leading to this dual listing in Hong Kong is also that geopolitical consideration, because there has been lawmakers in the US calling on the SEC to delist some of these Chinese companies, including Pony.ai. And James Peng did acknowledge that this is a de-risking strategy for them so that they have an alternative source of investors and funding from the Hong Kong listing. Although he said this was a long time in the making, even before they listed in a NASDAQ, they had an intention to list in Hong Kong as well. So it's not the entire factor, but certainly one of the considerations there.
Min, we know that this is a highly, highly competitive market. There's oversaturation, there's price war. It is a tough business to be in.
It is a tough business, and as you said, actually one of the biggest concerns for investors right now is the profitability of this company, because Pony.ai has been operating for, I believe, 9 years or so now in the red, right? They have been putting in a lot of capital outlay into their R&D, but the company said that they are at an inflection point now. They have finally achieved gross profit turning positive at a per vehicle level, which means that what they need to do now is to achieve a level of economy of scale so that they can achieve company-wide net income turning positive. He says that that needs to be at a 50,000 vehicle fleet level. They are now very far away from that. Their immediate term goal is to look at 1,000 vehicles in terms of fleet expansion in China. So they're looking at maybe 2028, 2029 as a timeline to achieving profitability. But at the same time, as you said, very, very saturated market. XPeng, for example, just held its AI day yesterday and announcing that it will be rolling out 3 new robotaxi models next year, collaborating with Alibaba's AMAP, that is a ride-hailing platform. And so, you know, Pony.ai, it's not just competing with the likes of XPeng, the car makers that are entering this space. There are ride-hailers, ride-hailing platform like Didi, also fundraising, also looking to launch new robotaxis next year. And also tech companies like Baidu's Apollo Go, that is the market leader in the segment right now. So a lot of competition in the sector.
Min, not a great debut for the two companies, but when you take a look at the IPOs in Hong Kong, I mean, it is set to top $40 billion this year. It's such a hot market right now.
That's right. You look at the visuals out of the Hong Kong exchange today, there were 4 gongs there, 4 companies listing on the same day, and it's been a red-hot market. We are looking at about $28 billion worth of deals so far up until about September, October of this year. And according to Bloomberg Intelligence, we could hit above $40 billion by end of the year because there is still a strong pipeline of companies waiting to list before the end of the year. Of course, a lot of it is because of government policy, right? The Chinese government has been speeding up the approval of these listings. They have been trying to encourage mainland companies to list in Hong Kong. You add to that the homecoming effect. Because of the geopolitical tension in the US, WeRide and Pony.ai are perfect examples of that. So these US listed Chinese companies choosing to do dual listings in Hong Kong, for example. And of course, you can't deny that the Hang Seng Index's outperformance so far this year, over 30% up year to date. That is also a factor for attracting some of these companies to list in Hong Kong as well. So yes, undeniably, one of the big winners this year is Hong Kong, coming up to the top of the rankings when it comes to the amount of deals this year.
We talk about how it's thriving right now. 12 months ago, some say it was dead. What a turnaround in terms of fortunes. Min, thank you so much for that. Bloomberg's China correspondent, Min Lo. Plenty more ahead. Keep it here with us. This is Bloomberg.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Let's do a check on markets and Asian shares getting a lift with investors coming back after a brief wobble in tech sentiment. A very brief wobble. The rebound fueled in part by upbeat forecasts, including from chipmaker Qualcomm. The AI rally in focus as investors also weigh comments from NVIDIA CEO James Peng. He told the Financial Times that China is going to win the AI race because of lower energy costs and fewer regulations. He also accused the US and UK of cynicism over AI, calling instead for more optimism. His remarks come after President Trump maintained a ban on NVIDIA selling its most advanced chips to Chinese customers. Let's cross over to the PWMA Wealth Management Summit in Hong Kong and bring in our next guest. Jean-Eric Salata is chairman in EQT Asia, the largest private markets firm in the world outside of North America. Jean, good to have you with us again. So, lots of debate about where you should park your money in terms of AI. It does seem like perhaps China is the way to go if you listen to James Peng.
Yes, well, I think Asia is going to be a leader in AI. We see it happening on the ground all over the region. I think it's still early days, and I think it's clear that this is going to transform almost every single industry. So I think as investors, we need to pay attention to how this is affecting all of our investments, not just those in the technology sector, but literally every company that we look at now. One of the first things we try to understand is what are the opportunities from AI? What are the risks presented by AI in that particular business?
How's your exposure looking like?
Well, at the moment, we're really bullish on what's happening in Japan. We see that as one of the biggest private equity opportunities in the region right now. The focus on shareholder value as a result of the shareholder reforms that are happening in Japan, the kind of mindset shift that we've seen, the now for the first time, positive inflation, positive wage growth that you're seeing on the ground, and a real willingness to transact. And I'm actually quite impressed with the sophistication of the management teams that we're finding in Japan now, which is quite different than what we used to see in the past. So Japan is a very active market. India, I would say, is probably the second most interesting market right now that we're looking at from our fund standpoint in Asia. And that's a market that continues to be a domestically driven story about consumption, demographics, technology, and I would say also services like healthcare.
There's a lot of talk about the attractiveness of the PE space in Japan as well as in India. Given so much interest, is that sending prices higher, valuations higher? What kind of follow through are you seeing on the back of that?
Well, I think what's been going on in the world in the last, really since April, I would say, since the tariff announcements, is that people have been looking at their concentration in their portfolios in the US and thinking that they're not diversified enough. And so people have been looking to Europe and to Asia as a way to diversify. And that's driving more flows into the region, which, as you say, is elevating valuations. I mean, you look at the stock market performance this year in Hong Kong, in Japan, in Korea, which is one of the top performing markets in the world. Who would have guessed? And this is a result of this kind of rebalancing that we're seeing in the world and people wanting to be less correlated, less concentrated. Doesn't mean that they're exiting the US, but they're just reducing weightings. And that marginal flow here into the region does affect valuations. But on the flip side for us as private equity investors, it also creates a lot more liquidity for our exits. And that's very important to keep our business liquid. And we've actually had a record year for exits this year in Asia. We distributed $14 billion out of our Asian program versus new investments of only $2 billion. So we've literally distributed 7 times more than we've invested this year on the back of this increasing liquidity. So it's very much a favorable tailwind, we believe, for the region's investors.
Is it too soon to be talking about PE consolidation? When might that happen?
Industry consolidation in the private equity industry, is that the question?
Yes, that's right.
Yes. So I think this is the trend that we're going to continue to see. It's already happening. What we're hearing from clients, institutional clients, is that they want to have fewer, larger relationships with their alternative investment firms. They don't want to have 150 managers doing different things for them. They want to have really a handful of strategic relationships with people that do multiple asset classes in multiple geographies for them. And that can also provide them with a lot of strategic co-investment deal flow, which is another important part of our industry. And so as this sort of industry consolidation takes shape, what you're seeing is the larger percentage of fundraising going to the larger global, in many cases listed private equity firms. And that, I think, is benefiting the larger players in our industry. You also have a very, very fragmented industry historically. We have something like 15,000 private equity firms in the world. It's just too many. And so I think there is going to be this shakeout where you're going to have some specialist firms that do very interesting niche strategies, and you're going to have these large global franchises that do multiple strategies for clients at scale.
Jean, your global CEO talked about the rise of zombie funds in Europe. Might that be happening in Asia as well?
I think it's a global phenomenon. It's happening in Europe, it's happening in Asia for sure. It's also happening in the United States. It's really about, have you been able to get distributions back to your clients? Are you delivering alpha? The reason to invest in private markets is to outperform the public markets. Otherwise, you're tying your money up for no reason. And so what we focus on at EQT, first and foremost, is delivering investment outperformance versus public markets. That is what keeps us in business. That's our number one priority as a firm, and it's our culture here to start with that. Then we figure out how much money we can invest well, and then we figure out how much money we can raise, not the other way around. How much money can we raise, and then figure out how do we invest it. So I think this focus on performance, and particularly I would say now the focus on distributions back to clients, is extremely important in terms of making sure your business has longevity and continuity. I think the second big trend in our industry, and I'm here at the Private Wealth Conference in Hong Kong, there's 1,500 private wealth advisors here today, it's a record attendance, is the new inflow of private wealth into our industry. And the question is, how is that capital going to be deployed, and where is it going to end up? And really what's happening there again is this consolidation story around it's going to a handful of the branded firms globally that have the brand, that have the distribution capability, that have really the multi-strategy and diversification that suits the needs of this new class of the democratization of our asset class to individual investors.
Before we talk about the allocation of that capital you were talking about, I'm just wondering, in terms of Asia's PE cycle, compare that to the rest of the world. Might that be, different from perhaps the US and Europe?
I think it is different. I think there's actually not as high a correlation as people imagine. And I think that's actually important for portfolio construction, because what investors are looking for is uncorrelated exposure to the asset class. So I think what's driving Asian private equity, if you look at, for example, the distributions that we're having, it's the level of activity in markets like India. India last year was, I think, the second largest IPO market in the world. Hong Kong this year is the number one IPO market in the world. And so when you have this kind of liquidity here at a time when liquidity is not as prominent in other markets, it does balance out the overall profile of an investor's portfolio by having some exposure to this part of the world. The other thing we have in Asia is we have a lot more growth. India is growing at over 6%. It's one of the largest economies in the world. It's the highest growth rate in the world of large economies. You have, I mentioned before, the deconsolidation story in Japan. You've also got some very exciting things happening in Southeast Asia. And even, I would say, in China now, we're starting to see a real growth engine coming from the innovation that's happening in China and the technology that we see emerging from China. And the domestic story there is also starting to look much more interesting.
You talked about wealth creation earlier and capital getting deployed. How is capital getting deployed?
Well, I think at the moment, as I mentioned earlier, I think more people are looking to rebalance away from U.S. assets and into Europe and Asia. I think Asia is a big beneficiary of that. I think the alternative asset space amongst individuals is starting to attract a lot of interest, particularly with the innovation around evergreen products. So evergreen products, our industry typically raises drawdown funds, which means you commit a certain amount of capital, it gets drawn down over a 4 or 5 year period, and then it gets invested and returned back to you. That's an institutional model. It doesn't work well for individuals. For the individuals, we have evergreen products now, which are essentially a vehicle that you can invest 100% of your money in on day one. It tracks the value of the investments on a quarterly basis. You have the ability to invest and redeem your money, although they're not really liquid, they're more open-ended structures, I would say. And that NAV progression is similar to what you track in the private equity structures of the drawdown funds, but in a much more approachable format and with much lower minimum investment thresholds. And so this enables a whole new class of investors to invest. On the flip side, I would say that it's incumbent actually on us as private equity firms to make sure that the people investing in our products are well educated and understand that these are different products. It's not like investing in the stock market. It's not like investing in a hedge fund or in a mutual fund where you have a lot more liquidity and where the risk profile could be different. So we need to do a good job of managing the way we educate and the way we manage the growth of this asset class, but it will ultimately result, we believe, in more people having exposure to what we do, which is delivering better returns over time than what's available in pure publicly liquid strategies.
When you take a look at the Indian market, are the deals generally too small for you?
Actually, India is really developing as a buyout market. So we're a buyout investor. We do control investments. And India's buyout market last year was about 10 years. If you go back, say 10 years ago, it was only a $2 billion buyout market. Last year was a $10 billion buyout market, so a 5x increase. This year it's going to be a $15 billion buyout market, up 50%. And the kinds of companies that we're seeing now are scale businesses in sectors like technology services companies, in sectors like healthcare, in sectors like financial services. And so there's a whole new generation of companies that have grown as the economy has compounded. You know, it's now one of the largest economies in the world. As the economy has compounded, the size of company has compounded. And the other interesting thing that's happening in India is the market cap of the Indian stock market is now something like $6 trillion, which makes it one of the largest stock markets in the world, which makes it a very viable exit market for private equity investors that can now exit larger investments at scale and get liquidity on those investments. So the whole financial ecosystem has really come a long way in the last, I'd say, 5 years, certainly in the last 10 years, which makes it a much more interesting market for investors like us.
So India looking attractive as a buyout market, but you remain cautious when it comes to China's buyout market. Is there a fair assessment?
I think China is an interesting market more on the growth equity and venture capital side of the spectrum, because there's a lot more early stage innovative type growth companies there. There's less maturity around established businesses that are looking to sell 100% of their business, or the generational change which often drives buyouts is just starting to happen in China. It's relatively early days. You have some corporate divestitures starting to happen, but again, it's a very small market, I would say, overall. And so it's not really a buyout market per se. It's much more of a growth equity market.
What risks do you still see in that market, Jean?
I think the biggest risk is AI. I think, we all talk about the exciting opportunity around AI, but it is also a risk. And I think the risk there is that we shouldn't underestimate the impact that AI is having in every single business. And if you're not moving quickly enough as a leader, a CEO in the business, to adopt AI, then you could be disrupted by a new entrant that's more AI native than you are. On the flip side, I would say that incumbents at the moment probably have an edge in that they have the scale, they have the customer relationships, they're embedded in the processes and systems of companies. So if you can quickly embed AI into the functionality of what you do, say you're a software company, if you can quickly add AI features and AI functionality into your software, there's no reason, not necessarily a given, that an AI native company can come in and displace you. I think the incumbents actually have the upper hand, but they need to move quickly. And so I think that's our job from a governance standpoint as owners of businesses, is to make sure we have the right leadership in place and that this is at the very, very top of the strategic agenda of the companies that we're invested in.
Jean, just one final question before we let you go. I'd like you to look into the crystal ball to 2026. Which market do you think will be the most active market for you?
If I had to guess right now, I would probably say it would be Japan. Just in terms of the deal flow, we've never had as active a pipeline as we have in Japan today. We have something like $8 to $10 billion of advanced investments that we're working on there. We announced the Fujitec elevator deal just a few months ago that we've signed. And I think the other one to keep an eye on is Korea, actually, which we think there'll be some more increasing opportunities there.
Jean, thank you so much for your time. It's been great. Jean-Eric Salata, chairman of EQT Asia, coming to us live from Hong Kong. Let's take a look at how U.S. Treasuries are shaping up, of course, in terms of the markets in Asia. Here we have a positive market with pretty much all benchmarks trending upwards. Still to come, we'll bring in UBP's head of fixed income research as a global bond binge lifts sales to a record this year of almost $6 trillion. This is Bloomberg. Welcome back. You're watching Insight. Bloomberg has learned that SoftBank explored a potential takeover this year of U.S. chipmaker Marvell Technology in what would have been the semiconductor industry's largest ever deal. Let's bring in Asia Tech Managing Editor Edwin Chan for more on this Bloomberg scoop. Edwin, we know that Masayoshi Son has been considering buying Marvell year in, year out. What's the reason behind that?
Yes, a pretty audacious deal by any measure, I think, if it had gone through. For want of a better characterization, I think it's safe to say SoftBank and Masa Son himself are trying to insert themselves, shall we say, into the AI narrative. I think, back in the day when SoftBank was at the center of the tech universe, in this AI ecosystem, its place is less certain. So part of what Masa is trying to do, I think, is using ARM as a foundation to become a major player in AI infrastructure. And I don't have to tell you guys how the major players in AI infrastructure have fared, what with all the trillions in envision spending that's coming down the pipeline.
I'm just wondering how this merger could reshape the semiconductor landscape.
Yes, and again, really interesting to know what's exactly in Masa's mind. I think he does want ARM to become a player up and down the semiconductor chain. ARM famously got its start with low-powered mobile chips. As data centers proliferate around the world, I think it has an edge, shall we say, in terms of power efficiency, which will become increasingly critical because you're going to need a lot of energy, electricity to power those data centers. So he wants ARM to be a player in that and to kind of shape how semiconductors, low-powered semiconductors for data centers evolve. So Marvell is kind of a specialist in bringing chip designs to fruition, and you can kind of see how it would complement ARM's architectural prowess and essentially build a better chip for data centers that consumes less power. Apart from that, we know SoftBank is pursuing an Ampere acquisition as well. It's a far smaller deal, but it also points to how SoftBank and Masa Son want to be an integral part of that data center semiconductor chain.
Edwin, thank you so much for that. Bloomberg's Edwin Chan coming to us from Hong Kong. Now, global bond sales have soared to a record this year, with issuance closing in on $6 trillion. And that's with more than a month to go in the rest of the year. As this chart shows, global bond spreads are close to the lowest level since 2007. These easy market conditions are helping borrowers to fund everything from the boom in AI projects to a revival in acquisitions. Let's get insights from our next guest, who is an experienced credit trader on fixed income products, Anitza Nib, head of fixed income research Asia at UBP. She joins us from Hong Kong. Anitza, how are you making sense of what we're seeing in the bond market right now?
Well, I mean, you're right in the sense that, there has been a lot of issuance and, breaking records as well. But I think that's also showing demand in the market for fixed income in general. In fact, recently we've been upgraded, our conviction on fixed income because we, started the easing cycle again by the Fed. And we expect the demand for fixed income remains strong going forward. Talking about credit spread, you're right. The credit spread has been sort of very tight at the moment at almost historical level, but we expect it's going to be resilient given the strong demand. And when you look at the absolute return of fixed income, in fact, it's not too bad when you compare that, with the spread together with where the U.S. Treasury's level at the moment. You're still getting decent return for DM credits, investment grade bonds, 5-year at over 4%. I think most investors still, prefer to go into the market and pick up some quality bonds and, maintain some carry.
So it is a binge. I'm just wondering whether it is sustainable. Do you expect demand to be sustained, in the coming quarters?
Yeah, we would expect demand for fixed income remain strong going forward and into 2026 because our view on the interest rate is that we still expect there would be cut in December by 25 basis points by the Fed. And going into 2026, we probably would see a few more cuts as well and bringing the terminal rate for the Fed fund rate to be around 2.75 to 3%. So based on this scenario, it's still a right timing in which, you go into the fixed income market to lock in the yield. In particular, for some investor who, would like to increase a bit of carry, they could also go into some of the perp or corporate high yields or some of the corporate hybrid or bank AT1s from that perspective. So we still expect, this trend to continue and credit spread to be resilient because we don't particularly see that there would be sort of events that would sort of, at the moment to cause the credit spread to widen from here.
But the thing is, the market's priced for perfection, we say, and yet we're still unsure about the Fed's trajectory, never mind what the market's pricing in, and inflation remains sticky. So we don't really know.
There's uncertainties in the market, but at the same time, when you look at, what Fed's consideration for the rate direction going forward would be inflation, labor market, and also the underlying growth. I think, the labor market still is one of the concerns by the Fed, in which they still see that the labor market is a little bit weak at the moment, and therefore something needs to be done in order to sort of, help the market to go forward in 2026 to have better growth. So that's why even with uncertainty, we still expect there will be rate cut going forward. And at the same time, yield at the moment is not, stretched at the moment. Yeah.
The Fed has said it will embark on quantitative tightening in December. Might that cause any funding strains at all?
Well, I mean, potentially we still expect there would be cut in December. But at the same time, they need to address the liquidity issue by year end as usual. So we expect, even though, they think about a pause, but the easing cycle still continue into 2026. So that's why we expect market would still be going into fixed income at this point, just to, grab the yield.
It is quite interesting what's happening in China's bond market as well. In fact, China's selling $4 billion of dollar bonds. Demand has been overwhelming. What do you make of the picture we're seeing?
Well, it is very interesting because yesterday we see the bond price with overwhelming demand. The order book has been so strong. When we look at the component as published by the lead managers, it basically saying a lot of asset managers, fund managers, as well as some banks are going into the deal. I think it's also a good diversification because we do not see a lot of jumbo Asia government sovereign deal in the market in US dollar, and that would be something that meet the demand for some of the fund managers. Think about it. In running a portfolio, you still want some sort of diversification. Of course, we like some of the yield in, higher yielding names, like as we mentioned, some corporate hybrid or some insurance companies. But at the same time, you also want some quality credits, to cushion any volatility going forward. So that's why we see, China bond is at the right timing to hit the market and, got very, very strong demand.
When it comes to the onshore bond market in China, it's huge, right? It's the second largest in the world, $25 trillion worth. But when it comes to ownership, it's under-owned by foreign investors. Do you see that changing? What would it take for that to reverse?
For now, we expect the domestic market would still be dominated mainly by the local players. Because I think, there's some things that the investor offshore have to think about would be including, for example, liquidity in the market and also the number of issuers that they can think about. So at the moment, I think, the domestic market, onshore market in China would still be dominated by domestic hands. But going forward, we expect if there are more variety of issuer, quality issuer, and also, there's some international rating agencies that rate those bonds, we reckon that foreign investor would also be thinking going into. For now, we believe that the foreign investor more generally interested more on some of the sovereign issues from the government or some state-owned entities.
Before we let you go, and it's your thoughts on the yuan. It does seem it is well supported. Yes, we're seeing a firmer dollar, but yet to date, the yuan is still up about 3% versus the USD. What do you make of the prospects for the currency?
In terms of the CNH?
Uh-huh.
Yeah, we still expect a range-bound market before year-end. The US dollar has been weakened over the last few days, but doesn't really have big impact on the CNH. We expect that would still be range-bound going forward and would also depending on the data going forward from China.
Anitza, thanks so much for that. Anitza Nip of UBP. Now to the top global stories we are following. China is rolling back tariffs on U.S. farm goods and lifting export curbs on American farms in moves tied to a new trade pact with Washington. The finance ministry will drop levies on soybeans, corn, wheat and chicken starting November 10th. Beijing is also removing 25 companies from its trade control lists after the U.S. eased its own tariffs on Chinese imports. The French government says it will suspend Chinese e-commerce platform Shein after complaints about the sale of weapons and childlike sex dolls. The suspension will affect Shein's online marketplace and not its first physical store in Paris, which opened just hours earlier. Shein says it hopes for discussion soon with French authorities. And Typhoon Maggie has now killed at least 116 people in the Philippines, making it the country's deadliest storm in a year. More than 500,000 residents have been displaced as floods submerge homes, with Cebu province reporting the highest casualties. A Philippine Air Force helicopter deployed for rescue operations also crashed, killing 6 crew members. Authorities warn another tropical cyclone could reach super typhoon strength by Saturday, bringing life-threatening conditions to Luzon early next week. And still to come, a deep dive into India's strained relations with the West. The inside story on how 2 alleged murder plots triggered a diplomatic crisis. Keep it here with us. This is Bloomberg.
On June 18th, 2023, which was a Sunday, Father's Day, Hardeep Singh Nijjar was leaving his temple at the end of the day. There was a car that got ahead of Mr. Nijjar's truck, forcing him to stop. Two men approached him from the left side.
The killing of a man outside a sick
There's been a murder investigation. They found Nijjar inside a pickup truck with gunshot wounds where he died of his injuries.
Make no mistake, this is a political assassination.
Around the same time, there was, according to U.S. prosecutors, a murder-for-hire plot unfolding in New York City against one of Hardeep Singh Nijjar's close friends.
The only thing I knew at that time is that my life is in danger.
And the governments of the US, of Canada, concluded that the murder of Mr. Nijjar and the targeting of Mr. Panun were initiated by people in some way connected to the government of India, which was angered by their involvement in something known as the Khalistan movement, the campaign for the Sikh religion to have an independent homeland in Punjab in northwest India. India has said allegations it was involved in Nijjar's killing are absurd. It has sought the extradition and arrest of some Sikh separatists due to what it says are links to terrorism.
The issue is not about freedom of expression, but advocating violence and legitimizing terrorism.
People in the Sikh campaign for independence around the world do have a habit of turning up dead.
Paramjit Singh Panjwar was shot dead.
UK-based Sikh campaigner has died in the early hours of this morning.
Police say the killing of a man outside a Sikh temple Sunday night appears to have been targeted.
There were these strange or suspicious deaths, threats against others in the wider Sikh community, and what U.S. authorities say was this murder-for-hire plot in New York against this other activist by an alleged gangster. The obvious question is, are they all related? And if this goes higher, how high does this go?
That's an excerpt of a documentary from Bloomberg Originals looking at how two alleged murder plots involving Sikh activists brought India, the US and Canada to a diplomatic crisis. Let's get more on the story with Bloomberg senior editor Matthew Campbell. Matt, India has said allegations that it was involved in the killing of the Sikh activist Nijjar in Canada are absurd. How did this result in a diplomatic standoff with Canada and the US?
Well, Haslinda, you may remember about 2 years ago, the then Canadian Prime Minister Justin Trudeau made these explosive allegations that agents of elements of the government of India had been involved, allegedly, in the killing of a Canadian citizen, a Sikh activist living in Canada. That was a big headline at the time. What was much less understood, and what I go into at some depth in this documentary and the accompanying story in Bloomberg Businessweek, was there was at the same time an incredibly complex diplomatic dance going on between the US and India, because US investigators, US prosecutors, ultimately US intelligence agencies and the White House had concluded that there was a similar alleged plot going on in New York City against a Sikh activist living there. This reached the absolute highest levels of the Biden administration. It became a real preoccupation of relations between the United States and India, a crucial relationship in the Indo-Pacific, and was about as big a source of behind-the-scenes political drama, espionage, law enforcement investigation as you could possibly imagine.
What's the history here, Matt? Why has India sought the extradition and arrest of some Sikh activists living abroad?
This Sikh separatist movement, what's known today as the Khalistan movement, traces its roots back quite a long way to the early 1980s, when some Sikh separatists living in Punjab in northwest India resorted to terrorism and violence as part of a campaign for greater autonomy. there were a number of clashes between those forces and the Indian state, culminating in a battle around the Golden Temple, which is the holiest Sikh site, that occurred in 1984. And subsequent to that, the Prime Minister of India, Indira Gandhi, was assassinated by two of her Sikh bodyguards who were seeking vengeance for these events. And there have been violent incidents going back and forth between these two sides, going back quite a long way. That is the history here, and that is why some of these feelings remain, even today, very, very raw. And this is a very intense debate and a very intense political struggle between, on the one hand, the government of India, now led, of course, by Prime Minister Narendra Modi, and Sikh separatists on the other side, who are these days largely living abroad in the United States, in Canada, in Europe.
We know you spent months talking with sources and going through legal filings and documents of the story. What was the biggest revelation to you on this story?
To me, Haslinda, the real surprise here was the extent to which this incident, the alleged targeting particularly of this Sikh separatist in New York City, became a central focus of U.S. foreign policy for a pretty long period of 2023, 2024. This was a huge deal for the Biden administration, and that was because for President Biden, for his advisors like National Security Advisor Jake Sullivan, his Asia czar Kurt Campbell, India was the whole ballgame. There was this long-term plan to develop India as a partner, if not something like an informal ally, to offset China. That was really one of the central priorities of the Biden administration all the way through. And yet you had, allegedly, people connected to the government of India involved in the targeting of a U.S. citizen on U.S. soil. So as you can imagine, that created an extremely complex situation for the Biden administration and for relations between these two incredibly important global superpowers.
You got to ask what it all means. India increasingly seen globally as a rising superpower. What does this saga say about India's standing in the world and, how it sees itself?
Well, I think we have to reiterate first that India has never taken or claimed responsibility for the alleged targeting of Sikh separatists living overseas. They have said that, in particular, allegations they were involved in the killing of Hardeep Singh Nijjar are absurd. That's the word they've used. Nonetheless, I think it is fair to say we are looking at a more assertive India, an India that, as it grows in economic and geopolitical power, is much more forthright in arguing for and taking action towards what it views as its security priorities. So I think the broader tale here is of a country that, after a long time in relative subordination in some ways to countries like the US, Russia, China, at the top table of geopolitics, is now absolutely at the top table of geopolitics and intends to stay there. And it intends to act like a country that is at that top table.
Matt, thank you so much for that. Bloomberg senior editor Matthew Campbell there. Now, subscribers can read the full story on the terminal at NI Big Take, as well as watching the originals documentaries, also available for website subscribers at Bloomberg.com. And turning to central banks and a couple of policy decisions on radar today, economists expect the Bank of England to keep rates steady at 4% ahead of the Labour government's budget that would end a run of once per quarter cuts that began in August last year. Meanwhile, Malaysian policymakers are expected to hold their benchmark rate at 2.75% amid solid growth, benign inflation, and a stronger ringgit. The central bank lost adjusted borrowing costs in July with a 25 basis point cut after holding steady for 2 years. And looking at the markets, Asian stocks striking Wall Street higher as dip buyers returned after a brief pullback. The MSCI Asia Pac Index is up 1.3%. There are signs of resilience in the U.S. labor market that's lifting sentiment somewhat. The Nikkei 225 also in the positive, up about 1.5% right now. When it comes to the Kospi retail investors are back. It's propping up the market there, up by 1.2%. So overall, a positive story. The Nifty index, though, currently down by 0.2%. Before we go, here's a look at our show tomorrow. We'll discuss the biggest risks to the global economy with former RBI Governor Raghuram Rajan. Mobius Emerging Fund Chairman Mark Mobius will also be joining us with his outlook on emerging markets. Plus, a spotlight on elections in India's Bihar states with Asia Pacific Foundation Senior Fellow Michael Kugelman and VoteVibe founder Amitabh Tiwari. That is it for Insight. Horizons Middle East and Africa is next. Do keep it here with us. This is Bloomberg.